I'm excited to have Dr. Joshua Lewer here today. A lot of you in the room know him. I met him through the EMBA program at Bradley. Arguably one of my favorite classes. Everything stays so current, including probably today. What he'll talk about, it might be a little different than the presentation from a week ago that he said. So Joshua Lewer is the Economics and Finance Department Chair at Bradley University. Dr. Lewer received his economics training at Augustana College for his bachelor's and the University of Nebraska-Lincoln for his PhD. Prior to coming to Bradley, Lewer served as the Gene Edwards Professor of Banking at West Texas A&M University. He is currently a research fellow at the Institute for the Study of Labor in Bonn, published 50 refereed journal articles in the broad fields of globalization and economic growth, and has written 6 books. Lewer serves as editor of the Journal of Economics Inquiry and enjoys following the stock market. He has a YouTube channel called The Enlightened Investor that covers current economics and investment issues. Dr. Joshua Lewer was appointed the McCord Professor in 2012. Please help me in welcoming him.
So Katie, thank you for the introduction, and I appreciate, she said like that was her favorite class she took. That's because her grade has already been posted.
Well, I got all A's.
So, whenever you invite an economist to the room, there always must be something wrong, right? So I guess that's the first thing we understand. The second thing is that I know you all, and you always say like at Christmas times, and we introduce each other, like economics, why do you teach economics? That was my worst class in college, right? And, I always say like, you'd like if you took it from me, but I don't know we'll see how this goes. But it's a pleasure to be here today. It looks like you guys have a great group, fun people. I know a lot of you, and it's good to be here. So what I thought I'd do today is just I'd like to spend some time, I'll talk to you a little bit about what's going on in the current state of our economy. I think there's a lot of uncertainty, about that. You can feel it. And we'll have some time for Q&A, right? That's the fun part. So I think I have some takeaways. I kind of wrote some notes up, and I have some takeaways, okay? The first takeaway, and I'll come back to this at the end. Risk happens fast, doesn't it? Personal risk and financial risk. So think about this just a little bit. Let's go back in 2008. Everyone here remembers 2008, right? I moved to Peoria in 2007. I couldn't sell my home back in Texas where I was from. It took me a long time. Well, anyways, Hank Paulson, do you remember Secretary Treasurer under, I forget, was it maybe Clinton? And Ben Bernanke at the time was the Federal Reserve Chair, quickly came to Congress and said, if we don't bail out banks in the next day or two, the whole system's going to crumble. Do you remember that? And there was a thing called the TARP. Remember the Troubled Asset Relief Program? Do you remember that? Okay. So, anyways, we got think about this. Last year in February, risk happens fast. If you were a betting person, you would not have ever guessed that Vladimir Putin would have invaded Ukraine and brought up our food prices and our energy prices, right? That's another thing that happened kind of out of nowhere, black swan. Well, in March of this year, just a few weeks ago, I don't know if I even sent you actually, I think I just sent this to you. Yeah. Yeah, I sent it, before this happened. So, Silicon Valley Bank, Signature Bank, Silvergate Bank, the number 3 to number 2 bank, get this, passed the Federal Reserve stress tests. Rating agencies rated them high again. Remember the whole rating agency thing? Jim Cramer, 2 weeks before on his show, said, buy Silicon Valley Bank. If any of you want to good investment advice, there's an ETF out there called the Anti-Jim Cramer. It's actually up for the year, and you could get that on your ETF at like Schwab or whatever you guys do. Anyways, in the last couple of weeks, the Federal Reserve has bought $700 billion of troubled assets again. we find ourselves in waters that aren't calm, right? Okay, so the first thing is risk happens fast. Second thing is the Fed is powerful. I took a group of students down to the Fed on Friday, right during the storms and stuff, and it was funny to like listen to them, speak. And but anyways, don't fight the Fed. Don't fight the Fed, right? And they raised interest rates from 0% to 5% in about a year. And when you do that, things break, right? We're all human beings, and we all know that we can adjust to things that happen kind of like slowly. Like if the temperature changes out kind of slowly, it's okay. But if the temperature changes, like, hey, what happened there? We can handle like things that happen slowly, but when things happen quickly, like we just saw happen with the interest rates, things break, and you get shocks in the system. Okay, so there definitely is a relationship between Federal Reserve activity and like equity markets and how stuff like that. The last thing I want to talk to you about is the theme of the day is people respond to incentives. And some people don't believe that, but it's true. And they respond to good incentives or bad incentives. Like if you're a parent, you want to provide incentives and guardrails for your young ones, right? If you are a bank evaluator, a regulator, you want to make sure that banks are safe. So the problem is that I think people need to bear risks when they take risks, and that should be on the upside and on the downside. Otherwise, we get this strange phenomenon called unintended consequences and what's called moral hazard. And I'm just going to read you what moral hazard is. Moral hazard is a situation in which one party engages in risky behavior or fails to act in good faith because it knows the other party bears the economic consequences of their behavior. And so as an economist, what I'm looking for is the trouble that lies in the growth of the bubbles, not the pop. Everyone's worried about the pop. Don't worry about the pop. Worry about the growth of these bubbles. All right. And so anyway, I don't know. I have a couple of quotes up there for us. One's about cash, right? I think Katie says she doesn't have a lot of cash on hand, and so she does Venmo, right? And cash is actually, there's risks to cash. You never even think about that, would you? Like, how is there risk to cash? There's risk to cash because there's the silent thief in the night, inflation, right? There's risk to cash because, hey, my bank, I can't get my cash out of there. There's people waiting in line in California to get their cash out of their bank and they couldn't get it out. And also foreign exchange risk. When we were born, go back in time, 95% of all foreign exchange transactions was completed with dollars. But today, you all know there's agents out there, and we haven't really done a great job as a country managing our finances, that only 55, 60% of all international transactions are completed with dollars. So there's foreign exchange risk as well. So you might say like, oh, I'm scared, I want to go to cash. But there's three issues there, right? And then anyways, there's another quote there from Warren Buffett. I think I can move this forward, right? And risk comes from not knowing what you're doing. And isn't that true? But the people at Silicon Valley Bank, you know what they did? They like cooked the books like Enron. They went into their actuarial science programs and they said, hey, these long government bonds, they're not risky anymore, and they like changed the program. Can you believe that? So anyway, interesting. Like, so what happened? Like, just a lot of different things happened. Let's see if we can move. Oh yeah, here we go. Move forward. Thank you. So this is just a graph that says here's some big banks, right? And we had Washington Mutual Bank was the largest bank that ever failed. It was like it's kind of small. It's like 300 billion, and then Silicon Valley Bank and Signature Bank, those both collapsed. They had 200 and some. But the thing I want to show you is that, like, we live in a world that's pretty uncertain, and these things, our backups aren't always perfect, are they? So the FDIC, they only have like 125 billion. And I mean, that's a lot, but think about Silicon Valley Bank at 200 and some billion. It took up all their reserves. So it's pretty crazy. So
how much is that 125 in sharing?
Trillions.
17 trillion.
17 trillion. Okay, yeah. Not enough, right? Oh yeah. I remember, people don't invite economists out unless there's something wrong. All right, so I think we all know this from our Economics 101 or Finance 101. What happens to bonds? How happens to bond prices when interest rates go up? What happens to bonds when interest rates go up? The values go down. Good job, right? So, and that was the problem here, is that the Fed kind of broke things with that spike of interest rates. So this is the 2-year Treasury, which follows the interest rates in the short run very closely in blue. And then in the red, what's that? That is the ETF of banks, of regional banks. So you can see that there's that negative correlation right there between interest rates and bonds. So here's interest rate risk example. Like Heather will love this. She's our accountant in the room. I actually get help I get help. I've never met an accountant I didn't like. So here's an example, like PNC regional bank. I don't know, some bank. They've got cash, loans, and assets. And I'm going to talk about assets here in a second. These are mortgage-backed securities and bonds. They can't own stocks usually. And then here's like their checking accounts and their net worth. Well, what happens if there's a 5% increase in interest rates like there has been? Well, you might get a 10% decrease in the value of the bonds. It's on paper. And so it goes from 450, it goes from 500 to 450. You see that? And then what happens when you have a reduction in your assets, as Heather will tell you, that the right-hand side has to decline as well. So that you now get a situation where the bank has been decapitalized, not because they're a badly run bank, but because they had too much long-term interest rate risk. Make sense? That's what happened. And then this is kind of small handwriting. I just want to show you, like, this is a statement. Whenever a statement comes out from the President of the United States, the President of the FDIC, the Secretary of Treasury, and the Federal Reserve Chair, you know something's serious. They usually don't get together in the same room, right? But one of the things they talked about is they said it several times. They said that these bailouts will not be supported by taxpayers. I think they say that almost in every paragraph, right? But the fact of the matter is that real? No. Who backs up the FDIC? Who backs up the Fed? Yes, right? So that's an important idea. Don't believe everything you hear, right? Moral hazard, protected from consequences. If all bank deposits are now 100% insured, what new moral hazards will be introduced into the banking system, right? If everything's backed up, and what was it, 17 trillion versus whatever 100, yeah, it's not backed up, right? Skip that. Okay, my last slide, then we'll get to Q&A. So this is a story it's the story of market-based capitalism, which is on the retreat. A lot of Americans, especially young Americans, aren't fans of markets because they're not fair, right? And okay. Okay. But what markets do, they're an engine for growth, and they really can, in many ways, help reduce poverty. So markets also, if you own a piece of capital, you've done very well. If you are not just a laborer, but owned some asset of some kind, like some capital or a machine or a building or a business or stock market equities or land, you've done very well in a market-based system, a capitalism, right? So get yourself some capital. So this is just a list of going back to the 1940s of things that's happened to our economy. And yet, after all that, markets prevailed. They did fine. It's a bet on the economy. So we had the war period, Vietnam in the 70s, hyperinflation in the 70s, commodity, crisis, real estate, banking collapse, flash crash of 87. Remember, people jumped out of the buildings in New York, right? They killed themselves for money, right? Asian contagion in the 1990s, tech bubble. Remember the bubble burst in 2001? Remember that? Amazon went to there. 9/11, global financial crisis of 2008, and the corona pandemic. That stunk. Everything that stunk. And then finally we got the financial crisis 2.0. And then, but at the same time, from 1940 to 2022, the stock market yielded about 11% rate of return. So be patient, all right? Don't be a gambler. If you want to gamble, go to Vegas. But if you want to have, maybe, there's no sure thing in life, but the market system works because people respond to incentives. All right, any questions?
Can I trade you and have you go to the podium and meet me? Oh, never mind, you keep that. Thank you.
You very briefly,
Push him home.
thanks. You very briefly mentioned decreasing poverty. That's a great point. Can you expand on that? Expand on how capitalism and markets decrease poverty?
Yeah, I mean, just look around the world. I think markets that are open do better, but it's not perfect. That's the issue, is that markets, if you want to make a moral justification of capitalism, go back to Adam Smith. He said that it's not, the people that served us that awesome ham today, they didn't do it out of the goodness of their heart. They did it, yeah. Yeah, so why do I teach at Bradley? I mean, because I just like giving lectures and researching all the time. I mean, that's a great life, but I have like young children to support, right? So people respond to incentives, and it's okay that we're self-interested in some way, because that's the power of the market force, is that it turns selfishness and self-interest into an asset. It's called the invisible hand. What other questions?
Hi, Dr. Lewer. We are looking at a really interesting expectation, I think, of a recession. The yield curve is about as inverted as we've seen in decades, with about a 1.5 point spread between a 6-month treasury and a 10-year. So everything seems to be pointing towards a recession. What are your thoughts and expectations?
Yeah, good question. So raise your hand if you think we're going to have a recession this year. Raise your hand if you think that we'll be fine this year and not have a recession. Raise your hand if you don't know. Okay, so my feeling is, I look at indicators like you. I look at indicators, and most economic indicators are screaming red. They're screaming recession. The main indicator that's not is the job market, right? And the weird thing is that we live in this time right now where the job market is just going to be tight for us moving forward. Like, that's good and bad for us. Like, our opportunities are going to be great, but the problem is we're not going to have enough people, right? We're 4.5 million people short in the labor market. And so the opportunities for you and me to do things that we're made to do are going to be there. At the same time, we're probably going to have a difficult time keeping and retaining talent. But if the job market breaks a little bit, that's the last leg, right? Because if you're talking about consumer confidence, if you're talking about the financial markets, if you're talking about the manufacturing sector, if you're, the list goes on, right? And the only thing that I can see that's really kind of is the job market. One thing I do worry about is U.S. savings, not just the rate at 3%, which is way too low, but the amount that's in households' savings accounts, I know there's talk like, oh, the money markets are flush with cash. That's primarily institutional money. But the households, which constitute 70% of the economy, they're running short on cash. So my feeling was this last holiday was probably another one of those big flush at spending times, but I don't know if it's going to be able to maintain itself moving forward. So no one knows the future. My thought is if I had scenarios of like what I say recession and who doesn't good times. I think the most likely scenario is recession in like this summer by June or July. And I think it's weird because everyone's predicting it, which means maybe it won't happen. All right, but there's good reason to be pessimistic a little bit.
I get to ask a self-serving question. I teach statistics for Professor Lewer. So a lot of our decisions are data-driven decisions. And even in sports, you've seen a lot of sports teams change to data analytics. You got to go by the numbers. And you even mentioned the indicators. Is there any place at all for intuition, for creativity? I know you say, invest for the long term, but are we all just data-driven and we never have any creativity or anything like that? Do we just follow numbers blindly?
Well, that's good. Yeah, that sounds boring, right? I mean, unless you're like an actuary, right?
Well, I teach, so.
I think everyone's unique. I think everyone's plan is different. So like your plan might be short run or long. I mean, think about what you want in life. I want a good life for my grandchildren. What it might be is everyone has a different plan, and that drives your emotions. That's one thing I would say. But I would, say also that it's hard to beat broad-based index funds if you're an investor. Okay, so I guess as an investment advice is like if you have something you want to do like in the next 6 months or a couple of years, 2 years, just kind of keep that in secure stuff. But if you have things that are longer run, like I've got a plan for like a second home, and who knows, right? Like where do you want to have a second home, Heather or Katie? Tennessee, right? So I want to get a second home in Tennessee, but that's like 5 or 10 years down the road. Well, maybe put some into a little bit of maybe the numbers don't say to do it, but just do it anyways to see if you can get there sooner.
You touched on it. What's the consequence of the dollar not being the reserve currency as far as we're concerned? What's the outcome of that?
So I didn't know if I was going to have a chance to have you. This is my reading assignment. Look at that beast. It's my reading assignment for you. Ray Dalio's Changing World Order. So the consequences of, and so this is a Why Nations Succeed and Fail. And the great book, I'll just kind of put it right here. There you go. So what will happen if the dollar continues its decline? I think we'll just feel a lot poorer because what happens is we import a lot of our inputs, right? And when our dollar loses its value, you see, we're going to have to pony up more, so our dollar won't go as far. And there are some forces out there recently. You might have heard, like some of the BRIC countries: Brazil, Russia, India, China, South Africa, as well as even Saudi Arabia, which was kind of our friends for all these years, right? They're now settling their transactions in other things than dollars. So it would be probably, maybe a recommendation to get something more hard or scarce, land or maybe a little bit of, Warren Buffett hates it, but it's got a high stock to flow ratio. Things that have a high stock to flow ratio will do okay. All right. Go ahead.
So you talk about moral hazard.
Yeah.
What I think is missing is legal hazard. I mean, Sam Bankman-Fried, isn't he still walking around free?
Yes.
And the board of directors of Silicon Valley Bank, aren't they still walking around free? And is there anybody who's ever going to go to jail for the 2008 financial crisis?
Yeah, watch The Big Short, right? Yeah, that's such a good point, is that I think, what's the consequences of this? This is the balance sheet of Silicon Valley Bank. So it's funny, I wish there was some, Scott, I'm not sure what to say on that one, but people have to be held responsible for, but I lived in Texas when Enron happened. I think we'll go through life, as you know, and there's gonna be bad actors in our life. So, you guys are a group of Rotarians, and it looks like you have some things up here. You stand for truth. And, it's not always easy telling the truth, or it's not always easy, but if you don't, who will? So, be that person that has credibility and high ethics. Otherwise, our whole system is in trouble, right? It's failure. Go ahead.
So have you read the book, The Creature from Jekyll Island?
No,
Have you not read that book?
I haven't read that one.
Okay, well, it's about the founding of the Federal Reserve. So how much would you say the impact of what's going on in our society and economy has to do with coming off the gold standard in 71 and the Federal Reserve?
Yeah, we got some nice time in the fiat currency years, right? We had the golden age of fiat currency, right? I'll answer you in a different way. So what's likely to happen in this fiat currency environment that we are in is that we're running imbalances at the federal government level, and in fact, even at the state of Illinois, although Illinois has kind of been paying off some of its obligations, which is really helpful to its credit rating. But we need to do austerity in the future to make this become balanced. And so we have to either raise taxes, cut spending, or print money. What's going to happen? We're going to have inflation because it's the most politically, it's like water, ladies and gentlemen. It rained so hard the other day. Hopefully you don't have a low spot, because the low spot, where does water go to? It goes to the low spot. And that's what's going to happen. It's easy. It runs there easily. Water runs there easily. And what the government's going to do is they're going to print money, because it's hard to raise taxes. It's hard to cut spending, and it's easy to print. So yeah.
And printing means borrowing from, define printing, layman's terms.
Printing means inflating the debt away with more money supply. And that's what that's kind of means, yeah. Very good. Thank you.